Do you invest in ETFs? When you start looking big picture, ETFs, of course, are exchange traded funds. They can offer a lot of diversification in the market. And in today's video, we're going to be looking at 5 ETFs, or really all that you need for retirement. And if you look at this ETF portfolio, it is going to encompass pretty much everything that you need with those exchange traded funds. So let's go ahead and get into it. So the first one we look at is an S&P 500 index fund. Now we know with the Vanguard S&P 500 ETF, or the VOO, this has an incredibly low annual fee. It also is a great place to start if you're new to investing, because this is actually going to be diversified by the nature. It is invested into the S&P 500, or the 500 largest companies within the United States. Within those companies, you are looking at all the sectors, all the industries, and of course, all of the mega cap stocks that we see. So when you think of Nvidia, when you look at Apple, when you think of Google, all of those are encompassed in here. And even when you look at the S&P 500 itself, it is incorporating about 80% of the entire stock market because of these mega size of these companies itself. So even if you're buying money and putting money into this specific ETF, you are going to be diversified across the 500 largest stocks within the stock market, which is going to be huge. So this is one where you can actually put money into it, just really set it and forget it. And honestly, if this was the only one that you were investing in, even under the advisement of Warren Buffett, putting money into the S&P 500 or following these index funds are going to really make a big difference for the rest of your life. Now, since this has been inducted, or the S&P 500 index funds have been around, they have averaged about a 10% return. When we start looking at those, when we look at the CD rates of around 5%, when you start looking at the high yield savings rates, which are around 5%, even looking at some money market accounts that might be around 5%, the equal weighting, or the S&P 500, is really a great place. Now, of course, you could do this a little bit different, which is the Invesco S&P equal weighted fund. This, of course, has lagged the S&P 500 itself, because instead of going in there and putting all your money into that S&P 500 index, which is weighted, meaning those, again, those large companies you're going to be getting a lot more of, the equal weighting uses all of those 500 companies and equally invests in them. So you actually get a percentage of those 500 companies that are there, making it a little bit different for an investment vehicle. Second one we look at is a total US stock market fund. This, of course, is another one. I do own this one as well, which is the Vanguard Total Stock Market ETF, or the VTI. So instead of just focusing on those 500 largest companies within that S&P 500, this includes all of the companies that are available in the US markets, which is about 50% of the entire global markets. So when you start looking at some of the mid-cap funds, even when you start looking at some of the small cap funds, you are invested into everything that we have on the United States Stock Exchange, which of course this ETF again has an ultra low 0.03 fee, which is crazy. When you start looking at Vanguard funds, and I have no allegiance to whoever it is, I have Charles Schwab funds, I have a bunch of different funds, but Vanguard does offer some of the lowest funds and lowest expense ratios that we do see when it comes to investing. And of course, when you start thinking of financial advisors, when you think of investment advisors, they usually charge about 1%. There could be monthly fees, there could be annual fees, there could be 1% of the portfolio. When you start investing that over your 20, 30, 40-year time frame, almost 30% of your investment can be eaten up by that 1%. And it's been proven mathematically when you start looking at these. And also, this is the reason why I focus on ETF investing and why I do not do mutual funds. When I start looking at mutual funds and I look at the cost of mutual funds, even though they are managed funds, I choose to invest in those index funds because, of course, they are very, very low, which means when the index is going up and when these companies within the indexes do increase, I am seeing a lot more of a gain because it is not being eaten up by those fees. And of course, guys, over on YouTube, if you like the content that I'm throwing out, please subscribe to the channel and let me know in the comments what you guys think. As we get into number 3, it is a total world stock market fund. Now, this one is another one that I did own at one point. I do not own it anymore. And this is the World Stock Market Fund. The Vanguard Total World Stock ETF, or VT, has the top holdings of essentially the first 2 ETFs, but they also have a lot of companies that are outside of the United States. Now, when it comes to international investing, when it comes to the world stock market, I choose not to go ahead and really compete or invest in there. Now, the reason, and this is my own personal preference, when you start looking at the largest companies within the United States, they are global companies. When you look at Apple, they're in almost every country. They're in the world. When you start looking at Google, when you start looking at Meta, when you start looking at these mega cap stocks, they are global companies. Even though they might be based in the US stock exchange, they are still global companies. But when you start expanding the horizon to the total stock market, like we're talking about, you start adding in Taiwan, you start adding in China, you start adding in Toyota, you start adding the Taiwanese semiconductor. There's a lot of companies out there. Now, this, of course, does take your fee to a 0.07, so a little bit of a higher fee. And when you start looking at the VTI and when you look at the VT itself, they are underperforming where we're seeing the S&P 500. And of course, this is because of the really big push with AI technology. When you look at the companies like NVIDIA that are just absolutely crushing the market, and also with the rise of artificial intelligence, thinking again of Apple, thinking of Microsoft, all of them are going to be very, very large tech companies that are going to be very well bedded in artificial intelligence for the years to come. And they're expecting by like 2030, 2040, that the stock market might double or triple, which I think is absolutely insane, but it depends who you watch. As we get into number 4, this is the Dividend Focus. Now for me, this one is the HD, and the HD, we know if you're invested in it, has just paid the highest dividend yield that they ever have. Literally, it has been the biggest dividend yield that we have ever seen within the HD, and it is the one that I hold for my Dividend Focus. Now, I also do hold the Vanguard Appreciation, or the Dividend Appreciation, the VIG. Again, not really allegiance to Vanguard, but Vanguard does have some really, really good funds. Now, there's a couple different ones you can get in here. And again, my preference for a dividend focused fund would be the HD. Some people do the VYM, which again is a Vanguard high yield, but there's a bunch of different ones out there. And of course, before you invest in anything, guys, do your own research. As much as we like the content on YouTube, as much as we like it on TikTok, do your research when it comes to investing. I've done an incredible amount of research. I've worked in the financial space for now 17 years, which is kind of crazy. I have worked with a ton of financial advisors. Even though I'm not one myself, you have to do your own research. You have to know what you're investing in. And just like Warren Buffett says, never invest in something that you don't understand. This, of course, any of the get rich quick schemes, any of the drop shipping, any of the cryptocurrency, if you don't know what you're investing in, you need to do your research. You need to understand exactly what you're investing in. And the final one on here is the REITs, which is the real estate funds. Now, of course, for a lot of people, REITs are kind of out of reach. It is for people who want to invest in real estate, but don't want to hold the real estate. That is the really, really big thing. You don't want to be a landlord. You don't want to be responsible for repairs. You don't want to do the property taxes. You don't want to do any of that, which is the exact same for me. Looking at the REIT-focused ETFs are really the way to go. You can even break it down like Realty Income. There's a couple of companies that do incredibly well with REITs, or you can actually buy a real estate index fund like the VNQ, which of course is comprised of a bunch of companies that do REITs themselves. Now, when you start looking at some of these, American Tower Public Storage, Realty Inc., Digital Realty Trust, there are a lot of companies, and this again is the reason why I do focus on the ETFs, is instead of going out and buying Realty Income or buying public storage, you can buy an ETF that is going to encompass, tens, hundreds, maybe even thousands of different companies comprised together. When you're looking at the ETFs, not only the big payouts that they do have, usually a much, much lower cost expense ratio, but you also have to note that most of these are unmanaged if they are the index funds. So again, when you start looking at the VTI, when you look at the VOO, when you look at some of those index funds, they literally just track an index. They don't do anything else. They are not managed funds. There's going to be ups and downs throughout there. And of course, when it comes to investing, it is long-term, period. If you're coming in for a year, if you're coming in for 2, maybe investing into the market is not really the best place. When you start looking at an investing time frame, I always think 5 years or greater. And of course, if you're doing this for retirement, if you're putting these into your portfolio, your 401k, your Roth IRAs, make sure that they are invested. I cannot stress that enough, where if you have money into IRAs, whether it be traditional or whether it be Roth, parking it at financial institutions are not going to see the growth, and you're not going to see the returns that you need to get ready for retirement. So guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.